Taxes, timing, and cash, what owners overlook until it hurts. There's a moment that catches almost every growing business owner off guard. It doesn't happen when revenue drops. It doesn't happen when a deal falls through. It happens when the CPA sends the tax estimate. And suddenly you owe six figures on money that isn't in your bank account. I've sat across from enough founders to know that this isn't about being irresponsible. Most of them are profitable. Most of them are growing. Most of them are doing everything right. And yet they're staring at a tax bill that feels like a punch in the gut. Why? Because profit is not cash. And taxes don't care about your timing. Let's talk about the three things owners consistently underestimate: taxes, timing, and the invisible gap between profit and liquidity. First, taxes. Most business owners think about taxes once a year, or maybe quarterly if they're disciplined. But taxes aren't an annual event, they're an outcome. They're the byproduct of decisions you've already made. Revenue timing, compensation strategy, distributions, entity structure, capital investments, all of those decisions quietly shape your tax exposure months before the estimate shows up. And here's where it gets painful. You can have a strong year, you can increase profitability, you can even improve margins, and still not have the cash to cover the tax bill because the money already went somewhere else. Maybe you reinvested in hiring. Maybe you upgraded systems. Maybe you paid down debt. Maybe you took distributions. All reasonable decisions. But the IRS doesn't evaluate reasonableness. They evaluate taxable income. That disconnect is where the stress begins. Now let's talk about timing. Cash flow problems are rarely about total revenue. They're about when money moves. 82% of small businesses fail because of cash flow issues, not because they weren't profitable, because they ran out of liquidity. Timing creates illusions. You can close a strong month on paper and still feel tight in your account. You can invoice heavily and still struggle to make payroll. You can show a healthy P&L and feel a pit in your stomach at night because revenue recognition and cash collection are two different realities. Taxes operate on one clock, cash operates on another. And if those clocks aren't synchronized, stress builds quietly until it isn't quiet anymore. The third piece, and this is the one owners rarely see clearly, is the gap. The gap between reported profit and available cash. That gap is filled with accounts receivable, inventory, debt service, capital expenditures, owner distributions, and tax obligations that haven't been set aside. When that gap isn't actively managed, it creates what I call phantom wealth. You look successful, you are successful, but you don't feel liquid. And that emotional mismatch creates anxiety. I've had founders tell me, I feel like we're doing well, but I'm still checking the bank balance before I sleep. That's not a revenue problem. That's a visibility problem. It's a forecasting problem. It's a systems problem, and it's solvable. One of the biggest shifts we see in growing companies is when they stop treating taxes as a surprise and start treating them as a strategic variable. That means forecasting taxable income before year end, modeling compensation structures in advance, understanding how distributions affect liquidity months ahead, looking at cash flow projections with tax obligations built in, not added later, because taxes aren't separate from operations, they're embedded in them. The same goes for timing. When you can see your 13-week cash forecast, when you know not just what's coming in, but when payroll, debt payments, and tax reserves are mapped out, something shifts. The emotional temperature drops. You stop reacting. You start deciding. And here's what's interesting. When owners gain clarity around taxes and timing, they don't just reduce stress. They make better strategic decisions. They hire more confidently. They negotiate differently. They invest with intention. They stop hoarding cash out of fear. They stop overspending out of false confidence because they understand the real number, not just the profit number, the usable number. That distinction changes everything. Let me share a pattern we see often. A firm grows from $3 million to $8 million in revenue. Margins improve, the team expands. On the outside, it looks like momentum. Internally, cash feels tight, tax bills increase, working capital gets absorbed by growth, debt payments rise. Owners take distributions without modeling the impact. Nothing is wrong, but nothing is coordinated. And that lack of coordination is what hurts, not immediately, but eventually, usually at the worst possible moment. There's also a psychological component here that we don't talk about enough. Many founders tie profit to success, which makes sense. But liquidity is what determines stability, and stability is what determines sleep. You can survive with thinner margins. You cannot survive without cash. That's why visibility matters so much. When financial visibility is low, decisions default to instinct. When visibility is high, decisions align with data. And that shift alone changes the trajectory of a company. If you zoom out, taxes, timing, and cash are not separate topics. They're one ecosystem. Revenue strategy affects taxable income. Tax planning affects distributions. Distributions affect liquidity. Liquidity affects hiring and investment. Hiring affects revenue capacity. It's all connected. And when you start looking at it as a system, instead of isolated events, the surprises decrease, the panic moments decrease, the sleepless nights decrease. I want to leave you with something to think about. If your CPA sent you a projected tax bill tomorrow, would it feel expected or would it feel like an emergency? If revenue slowed for 60 days, would you feel steady or exposed? If you stepped away for a month, would your leadership team know exactly where cash stands? Financial maturity isn't about bigger numbers. It's about fewer surprises. It's about understanding how taxes, timing, and cash interact before they hurt, because they will interact. The only question is whether you see it coming and what would change in your business and in your life if you did.